So yeah, good morning to everyone who's present here. I hope my screen is visible and I hope I'm audible. So I'm Naveen and I'm a research analyst at ithought, and I'll be heading this webinar. And just as the title says, the purpose of the webinar is to understand Eternal, and the way we'll be going about it is like first of all understand the industries that in which it operates, which is food delivery and quick commerce. And then we'll also touch upon, how the macro scenario looks for both these industries and how exactly Eternal is doing and what's in store for Eternal as a company moving forward. Yeah, what this webinar is not about is we're not here to give any advice or recommendations. This is purely educational, and it's pointedly meant to make one understand how exactly to follow this company and how to understand all the numbers that they put out. So without further ado, let's just jump right into it. So first, we'll be starting with food delivery. And this is the first vertical that the business also started back in 2015. So before we talk about any of the competitors, we'd just like to touch upon how exactly food delivery works as a business. So essentially, this is a neat little picture that tells us what exactly happens and some text to go with it. How we should be looking at food delivery is once we as a customer place an order, the it contains largely three elements. So one is going to be the cost of the food, one is going to be the platform fee, and one is going to be the delivery fee. And I'm sure many of you would have noticed these three components. Uh, the cost of the food, so a percentage of the cost of the food is kept by the food delivery app itself as commissions from the restaurant, and the rest is passed through to the restaurant. As for the platform fee, the company completely keeps it. As for the delivery charges, the delivery fee that the customer pays is typically not enough to cover the delivery fees for the delivery partner. So Zomato adds some amount to it and then passes the entire amount to the delivery partner as wages. So roughly, this is how the transaction works from the perspective of a customer. From the perspective of the app itself, this is an illustration of how it works with a company. So roughly, when it comes to revenue, the commissions from restaurant partners, as well as the customer delivery and the platform fee, are the major elements. And out of the both of them, 75% of them are from commissions. So that's the thing to watch out closely. Now, as this line suggests, there is some ad revenue from restaurant partners. Now, what does that mean? So essentially, when a restaurant feels that it's in a very competitive space and they want to pay to be more visible on the platform, or they want to be on a banner on the platform, they pay an additional percentage of the order to the app to get these things done. And that's why you see all these promotions, and in festive seasons, you see different restaurants advertising their products on the apps as well. So that is captured in the ad revenue from the restaurants. Now, additionally, there are two charges that the company makes, and one of them is a pass-through and one of them is not. So when it comes to a surge fee, you would have seen that there are some times, like during the evening of an IPL match where Chennai is playing in Chennai, there's a lot of like delivery volumes that come to a company. So in order to manage the volumes, they kind of use the surge fee as a tool where the company gets the additional revenue. But when it's rainy, there's a need to incentivize delivery partners to take up orders. So there's an extra rain fee that is charged to the customers that is completely passed through to the delivery partner. So this is the entirety of how the revenue works on an order basis. Now, when it comes to the cost, it's very effective to think about it in as three parts. So one is the delivery fee, which is always going to be there, which is what you need to pay the delivery partner. And then per order, there are some costs that are required to facilitate uh, the service itself. Like, for example, payment gateway charges, which is, smooth, ensuring smooth payments from the customer's end to the app itself. And, there are some costs associated with hosting the app, like the cloud charges, etc. So those scale exactly with the order volume. And then between the costs that take to that are levied per order. There are some other costs that bridge this gap to the operating profit of the company itself, which is like the company needs employees to operate. They spend certain amount on marketing the app itself, and those are captured in the third bucket. Now, to understand how exactly these costs and revenue, the interplay between the costs and the revenues, let's just look at a broad unit economics profile for food delivery companies. And bear in mind, these are based on average numbers to just illustrate qualitatively and quantitatively how exactly these orders work. So, roughly, one important thing to keep in mind is that the revenue that all these companies make are always a percentage of the average order value, but the costs are not. So what this means is that as the average order value increases, the revenue increases, but the costs more or less remain the same. So this implies that average order value is a very, very important point. That is like per order, how much the customer pays is a very important metric when it comes to profitability. We'll discuss exactly what the metrics are to look in detail later in the presentation, but just wanted to highlight when we're looking at unit economics. So roughly, the company takes 21% home from the amount that you pay on per order. And then it costs around 80 rupees to service that order. And, if we assume the industry average of 460 rupees as an average order value, then the company makes about 15 rupees of operating profit. And this is how the costs are broken roughly. So moving on. Now that we know how each order works and we're comfortable with that, let's move on to look at the industry as a whole in our country. Now, the way you should be looking at food delivery as an industry is as a part of bigger industries. So, the food services market essentially includes all occasions of a person eating out in the country. Among the food services, there are organized as well as unorganized players. So among the organized players is where the food aggregators or the food delivery apps operate. Now, roughly as of financial year 25, the food services market itself is somewhere around the 70 billion US dollar range. Among that, around 30 billion US dollars is like the organized market. And among these $30 billion, 10 billion is contributed by food delivery. Now, as per various research reports and even this one, the expectation is that all three buckets are meant to grow, but the organized food delivery as well as the organized food services as well as the food delivery are expected to grow faster than the food services market. And the food delivery industry from $10 billion to in FY25 is expected to compound at maybe 12 to 14% and reach somewhere in the range of 17 to $19 billion. So this is roughly how you should be looking at the industry from a 5-year standpoint, and there is healthy growth left in the industry. Moving on. As we all know, around 2015, Swiggy and Zomato launched their food delivery services, and they are the biggest food delivery players in India as of today. But in the decade in between, that was not always the case. So this table is just a reminder of how many people tried to enter and how many people could not make it in the food delivery business. Two main players that I would like to highlight are Ola, which tried twice to enter the food market and by 2019 they gave up, and Uber Eats, who tried to sustain and who had, sizable market share in the Indian food delivery industry back then. They couldn't sustain operations through COVID and they sold their India business to Zomato. Moving on. Since then, however, since the consolidation, there's been talks of a new entrant, and I'm sure we've all read media reports about Rapido's Only, which, it's a pilot initiative. It's not there everywhere. But the key thing to note about Only is its value proposition to both restaurant partners as well as customers. So, from a restaurant partner perspective, as we have discussed, what the food delivery apps that exist today pocket are a percentage of the order value. Now, as the order value increases, though it is good for the food delivery app itself, it's not that great for the restaurant partner. So what Only is proposing is a flat commission model where they charge 25 rupees, that's the number as of today, per order to the restaurant partner. So they can also benefit if the average order value increases. Additionally, to the customer, because some restaurants that service the value customer cohort, they're not able to keep up their profitability in platforms that exist today. For them, only seems like an attractive option because of this fixed commission model. Hence, for customers, only claims to offer a variety of options at the value segment, somewhere around the 150 rupee price point, which is much more sustainable to the average order value that we discussed earlier, which is north of 400 rupees. So essentially, this is only pitch, and these are early days, and we're not entirely sure about how well this model will do, how profitable it will be, how well the adoption will be. But this is something to closely watch in the industry. So this about wraps up what the food delivery industry has been about and what the food delivery industry has in store for us. So then we'll just quickly move on to quick commerce, which is the big talk of the town, and I'm sure many of us would have read media reports about it as well. So briefly, to just touch upon what quick commerce is, as we all know, it's just delivery of groceries and lately other retail category items to people's homes minutes after the delivery. That's the entire value proposition of quick commerce. Is essentially you get things that you order within half an hour of the delivery period. Now, we'll follow the quick commerce industry just as we did for food delivery so far. With this, we'll first discuss how exactly each order works. Now, the major difference between food delivery and quick commerce is this bubble here called a dark store. Now, a dark store is like a mini warehouse, which is 2,500 to 4,000 square feet on average across players. And the purpose of this dark store is to get as close to the customer as possible to reduce the delivery time within half an hour, but also to reduce the delivery cost that goes along with it. Now, what this implies is since the dark store is very small, the amount of SKUs that you can keep in there are also relatively small. So this necessitates the company having a bigger warehouse somewhere further that constantly keeps replenishing the dark store inventory on a frequent basis. Now, as you can imagine, this extra link in the chain adds to the cost per order, which is captured in our revenue and cost model. Now, there's just a few difference between how food deliveries revenue and cost model work with quick commerce, and I'll highlight them. So first is going to be your selling margins instead of the commission from the restaurant partners. So essentially, this is very similar to how a retailer would work in any other industry. So essentially, these companies procure inventory from brands at a discount from MRP, and they sell the products at MRP or few percentage points cheaper than the MRP. And the difference between what they procure for and sell for is selling margins. Additionally, with respect to costs, these other logistics costs associated with each order, in addition to what they have to pay the delivery partner, is captured here. And essentially, this is how we bucket the costs and revenues for quick commerce. Now, moving on to unit economics as we saw for food delivery, here again, the revenue that the company makes is a percentage of the AOV, whereas the cost is not. And as we can see here, it costs operating costs are about 135 rupees at current order volumes and the way the current businesses are structured. And they take home around 20% of the order. And essentially, since profitable is so far has been very spotty for the industry, instead of taking an average operating profit, I've chosen to display an average net order value for which the companies break even, which is for now at 670 rupees. So broadly, the understanding is if a platform has an average order value that is post discounts of 670 rupees, then there's a reasonable chance that they are breaking even. So again, as we discussed in the food delivery business, average order value is a very key lever for profitability. And as it increases, we'll see profitability also increase. Moving on. The way we would look at the quick commerce industry is fundamentally as a distribution channel for Indian retail. Now, looking at its peers, so there's general trade, which has always been there in India. There's modern trade, which is like your supermarkets and all other organized players like DMart. And then there's e-commerce, which is compared to general trade and modern trade, a relatively new phenomenon. And quick commerce, which is much newer than all players, right? So this can also be an opportunity to understand why quick commerce is so popular as an industry. So if you see, as labeled here, uh, uh, quick commerce is only a 0.3% of all retail distribution in India right now. And the retail market is somewhere around $950 billion. It's a pretty big market. And as you can see here, it's poised to grow at a very, very fast rate to reach 2% of the retail market, which is still a very small share. But out of a retail market that's, in financial year FY30, around $1.7 trillion, which implies, 3 lakh crore quick commerce market. And looking at these numbers, it can be a very good reason to understand why there's so much activity in there because everybody wants a piece of this pie. Moving on. Yeah. And as just to qualify uh, who has shown interest in the market, just compiled a table. I hope my screen is visible. Yeah. Um, Essentially, this is just an indicator of who is in the quick commerce market and the scale of their business in very rough terms, right? As you can see, Blinkit, Instamart, and Zepto, as we all know, are the top three players, and they have been in the market for 4 or 5 years now. But all the other entrants are relatively new, barely a year old. And as you can see, these competitors, the top three, are also head and shoulders above the others with respect to dark store counts. And bear in mind, we'll discuss the effectiveness of number of dark stores as a metric to evaluate these companies later on. But I've just given you a rough idea of the network size to make you guys understand like at what scale they're operating. And then, uh, orders per day is also a way of understanding the kind of throughput these guys are doing. So I've just briefly listed these guys on. The most important thing I'd like to highlight here is GeoMart. So it may be a little deceptive to see 600 dark store, but 1.3, 1.6 million orders per day. And this is mainly because they have a very unique business model where some of their Reliance retail stores that they have, Reliance Fresh stores they have in some of the tail end markets, double as dark stores. Now, I won't be going into depth of how exactly this model works or has it worked well so far because honestly, we don't have the clarity so far as an industry, but just thought I'd highlight because of this anomalous number. Moving on. Before we move on to look at Eternal as a company and pick apart how exactly it got to where it is right now, I'd like to touch upon the other side of this equation, which is the people these companies are trying to sell services to. Now, there are broadly a couple of ways of looking at India as a market. And like this pyramid is one that's very famous. So it's cited by many surveys, many reports. And I've taken an image from one of these research reports that classifies India based on how they consume. So roughly how you're supposed to look at this is the emerged India and emerging India, where emerged India is like, some of the more affluent consumers who are already using services like quick commerce and extensively been using e-commerce for the last 10 years. And emerging India, who's coming into an income bracket and a mindset to adopt all these services at scale. Now, this roughly adds up to around 40% of Indians. and these are our target markets. Sustaining India is, they're the bottom chunk of the pyramid, and the 60% of the Indian population, and they're not an area of focus because they won't be able to afford these services, or they won't be the target consumers for these services. Now, from a household expenditure point of view, roughly, if you see, the key takeaway is that the top 40% is set to double what it spends on a monthly basis. Yeah. And these are numbers just indicating at what rate these household expenditure numbers are meant to compound, and how they're roughly looking 5 years, 6 years down the line. This is one way of looking at it. The other way of looking at it is to break it by, like, whether they're middle class or whether they're upper class, or whether, from an economic standpoint, right? And as this visual indicates, the upper middle class and lower middle class are set to expand extensively in the next few years, fueling consumption. And hence, as you can see, it's evident in the discretionary income. So it's supposed to grow to $4,000, which is significantly higher than it is today. And obviously, internet adoption and online shoppers are also increasing. So all in all, this section of the presentation leads us to understand that not only are food delivery and quick commerce as industries very small at the moment and have very good growth trajectories, the consumers that they are targeting, that is the base in which they are trying to grow, is also growing at a very rapid pace. So all in all, the consumption story for India as well as these industries look robust, which explains a lot of why there's a lot of interest shown in these industries. Moving on to Eternal as a company. Now, this is a very interesting company because in all of the Nifty 50 companies, this is one of the first consumer internet companies which has reached this unprecedented scale. So currently trades about 2.6 lakh crore, which is like an insane valuation for a company that just started 10 years ago. And if you look at it, it's some of its peers in the Nifty 50 will be very surprising. So broadly, what is Eternal? So they started out as Zomato back in 2008. They were a menu listing platform initially, and then they started food delivery, which was the first major business vertical in 2015, and they scaled the business very well. And in 2022, they acquired Blinkit to enter the quick commerce industry. Both of these industries we've just discussed so far, which have grown very quickly and are expected to grow further as well. And so far they've been so this is how they've been going on so far. Just to summarize some key events from the history of like Eternal. So again, they started as a menu listing platform. They launched their food delivery services in 2020. They reached a decent scale, and then they also acquired Uber in 2020. They IPO'd in 2021. In 2022, they acquired Blinkit. And in 2024, which is the latest big bet, they acquired Paytm Insider. So this is roughly the trajectory of how Eternal has grown as a company. And this is just their price chart with some key events highlighted. So as you can see here, this was around the time they listed, and this was around the time the Blinkit acquisition happened. And as we can see, there was a lot of fatigue after the COVID era, and the Blinkit acquisition also was not met with a lot of enthusiasm by investors. And so it was flat for a little bit before profitability started to show up in a major way, after which the stock kept rallying and never looked back. And, obviously there was a minor drawdown last year when the, intensity of the quick commerce competition increased, and it continues to be very high. So this is just a summary of how the company has been doing. Moving on. From this point on, I just like to shed a light on some of the operating metrics, and and kind of understand how Eternal uh, works through these metrics, and how to understand how competitively dominant Eternal have been, and why the market respects Eternal much more than its peers. As we all know, Swiggy, their biggest listed peers around, has a market cap of around 90,000 crore, even though they do very similar businesses. So why has the market given Eternal such a premium? And we'll try to understand that through numbers, through these key metrics. So one important thing I'd like to highlight before we go into these, all of these key metrics are publicly available, and fortunately for us, they're available in their shareholders' letters, which are very important that they disclose every quarter, and they're very detailed. So they have FAQs, they have tables and tables of data that I've brought all these numbers from, as well as some of the images that I'll be sharing on later. So now let's jump into the key metrics and how exactly we're supposed to understand these companies. So the first one would be GOV and NOV. So what does gross order value mean? It's essentially the sum of everything customers paid, GST, everything included. So it just indicates volume level movements for the industry in a very succinct manner. So that's how this works. And off late, Eternal has started disclosing NOV instead of GOV, which is essentially GOV minus discounts. So again, as they say correctly, this is a much better indicator of how exactly uh, the business volumes have grown, because discounts can skew our understanding of how the industry is growing. So, for the purposes of the presentation, I'll be using GOV because we have historical data for GOV only to compare. And another additional point is that Swiggy discloses GOV and not NOV. So, in order to compare these companies to understand why Eternal is priced at a much more like premium compared to Swiggy, I'll be using GOV. So as we can see, there's a clear discrepancy in scale, and as of 2025 as well, Eternal has been growing faster. And this roughly translates to about a 45% market share for Swiggy and a 60% market, like GOV share for Eternal. With respect to shares, the one thing that I'd like to highlight is all these industries that we are looking at are constantly changing, and they have a high amount of competition, and hence it may not exactly be the right mentality to anchor ourselves to a certain market share for a company, because that keep changing. It is true for food as well, and more so true for quick commerce, where we see people or companies entering the market and exiting them daily. Having said that, looking at the GOV numbers, at least you can see there's a very clear discrepancy between the scale of Eternal and Swiggy. And scale is one of the very important things to run these kind of businesses at profitably. So moving on, the next important metric that we should be looking at, and as I've highlighted at the unit economics level as well, is the average order value. Now, for food delivery, if you look at it, like the average order value as of 2025 is very similar for Eternal and Swiggy. But there's a very, very clear discrepancy between the average order value for Swiggy and Eternal when it comes to quick commerce. And, uh, strategically, everybody's trying to increase this as it's a very important lever of profitability. So this is something that we should be closely tracking. And just as we discussed for GOV, Eternal has started disclosing this NAOV, which is the net average order value, which is again the average order value, like minus discount per order, which is a better indicator of how well the business is doing. Now, moving on to the next important metric is the monthly transacting users. So essentially, this is an idea of how many people are using the app. So this is a very good indicator to understand. So one very good way of looking at this monthly transacting user would be to compare it with the opportunity size that we just discussed in the macro slides, where we saw the pyramid and we saw the top 10% of India. And as we all know, India has about 140 crore people, and the top 10 translates to 14 crore people. So even compared to that customer cohort, on a monthly basis, we have only 2 crore users using Eternal and 1.5 crore users using Swiggy. So this is another way of looking at how big the current market, I mean, the current companies are, and how big the market is currently, and the growth potential for all these industries. and hence understand why there's so much industry. I mean, why there's so much interest in these industries. And then again, the story only gets better for quick commerce as adoption is much lower. And as you can see, the growth has also been robust. So this is one very important metric that we need to keep seeing in order to understand how many people have been using these services at a meaningful frequency, just like per month. Then we come to take rate, which is, as we discussed, percentage of the gross order value that the company takes home. As we discussed, this is also very important for profitability, and this is how the current commission model works for food and quick commerce. So as you can see, the number on average for food is like around 21, 22 for the biggest players. But for quick commerce, it's a little lesser. Now, roughly, if you want to understand why this is so, there may be two reasons. One is that with respect to profitability, food delivery is a little more mature because it's been around for a little longer. And as you might have noticed, food delivery platforms have started charging the platform fee and they've increased the commissions for restaurants over the years as user demand started getting solidified for the service. Now, quick commerce is in a relatively early stage of adoption. What this essentially means is companies are not at the stage where they can rely on demand to increase how much they take home and increase their profitability. So this essentially translates to more discounts and less diluting their sales margins in order to get more people to use these services. So that is why optically these two look lower. And another way of understanding these numbers is that food delivery as a service is a more discretionary category compared to quick commerce. Now, what do I mean by that? I mean that grocery delivery and delivery of other things are likely to be used by a wider customer cohort compared to people who want to get food delivered. And this is another way of understanding why quick commerce is poised to grow at such a fast pace. So that's broadly about why the take rates look this way. And moving forward also, there's no expectation that the take rates of the quick commerce companies, come close to or even beat the food delivery category. They are expected to remain lower than that of food delivery. Moving on. Next is the contribution margin, and this is where some of the, I wouldn't say complicated, but some of the more proprietary ways of understanding these businesses come in because lots of other traditional companies don't use metrics like this. And the way to understand contribution margin is very, very simple. So it's just revenue minus all variable costs as a percentage of GOV or NOV. And here we've taken GOV for ease of comparison. And what this essentially indicates is that all these costs that are used to service orders are netted off when it comes to contribution margin. So essentially the way to think about it is once contribution margin reaches a certain level, then companies can start gunning for operating leverage over their other fixed expenses. So this is a key lever for margin expansion. Now, what do I mean by this? What I generally mean by this is essentially profit they get out of just on an order basis, where like once this gets to a certain level, everything else with respect to cost is not going to scale linearly with volumes, and incremental volumes will lead to incremental profits. Now, that is why this is very key to understand because this is more like a very important checkpoint when it comes to profitability of these businesses. So once a first a company has to attain contribution break even, that is, they have to start making money on an order basis. And then once the profit per order reaches a certain level, then they can start, paying for the operating costs also from those profits and hence take home more cash. So with respect to food delivery, if you can see, the number has been steadily increasing, and it's gotten to a point where it's it's also providing cash for the company itself. So it's gotten to 8% for Swiggy and around 7.1% for, I mean, 8% for Eternal and 7.1% for Swiggy. When it comes to quick commerce, it's very apparent that the industry is not as mature as food, and hence the contribution are much lower. As you can see, it's at -4% for Swiggy, but it's reached a decent amount for Eternal. Now you must see, okay, 2023, the number was much higher and it's dipped. That's because of competitive industry that we discussed in the price chart above. Now, the next step is important. So, when it comes to key metrics, adjusted EBITDA has received a lot of criticism because it's such a non-standard metric and it includes some costs that many investors feel are key. Now, I'll provide my assessment of this metric and why I think it's important to pay attention to. Now, let's just look at briefly what exactly adjusted EBITDA is. So, adjusted EBITDA is essentially revenue minus fixed and variable costs, right? And additionally, we have to subtract rental cash flow from it. And we add back the ESOPs. So these are the two main things that you need to pay attention to. Now, why do we need to separately remove rental cash flow? To understand this, we just have to go back and understand a basic change in how accounting worked before 2020 and what changed. I'll keep this very simple. So what happened was before 2020, whenever a company had a leased property and they had to pay rent, all of it was in their profit and loss statement. But due to an accounting change in 2020, the lease the lease had to go to the balance sheet, and hence, as you can see in this image, the single expense is no more in the profit and loss statement above the EBITDA level. It is now below the EBITDA level as a part of depreciation and interest. Now, there's a lot of nuance to how this works, and we don't need to jump into the detail. But what we essentially need to understand here is when companies lease properties and they have to pay a rent for them on a recurring basis, that is not captured in the EBITDA line item. So, in order to understand more of how the cash works, it is good. So, another important thing is all these companies, since the advent of quick commerce, they started leasing a lot of dark stores, and hence the rent that they need to pay for the dark stores is a very important cash item that we need to pay attention to. And hence, as this is not captured in the operating cost in the profit and loss statement, this adjusted metric accounts for it in order to give a better picture of the operations of the company. And ESOPs. So, as we all know, all consumer internet companies are very, very infamous for providing a lot of stock-based compensation for their employees. Now, in terms of operations, this is not very important. And, just to judge how much cash in and cash out of the company is flowing, you don't need to pay attention to these ESOPs. But it is very important to note that in steady state, when we're looking at these companies when they're mature, ESOPs are an important part of the P&L and should not be neglected. But for now, the argument that the adjusted EBITDA margin makes is that rather than taking the EBITDA or the PAT, this metric is very, very close to the cash generated by the company. And that is what is very important in this growth phase for the company. Just to illustrate how adjusted EBITDA gets converted to cash, I've just taken a screen grab from one of the shareholder letters for the latest quarter to just illustrate what are the different things that separate an adjusted EBITDA from the cash in the company. Now, as you can see, treasury income and capital expenditure incurred are not, a part of the profit and loss statement, and neither is the working capital change. So just to understand if the company is burning cash or not, the adjusted EBITDA is a very good metric to track. Now, is it the end all be all metric where we can stop and just forget about earnings per share? That is not the case. You should still track earnings per share, but at the moment, in order to get a better clarity on the operations of the business, then adjusted EBITDA is a very good metric to look at. And another way of just getting a sense of this is to look at the bridge between adjusted EBITDA and the profit and loss statement and how these rent costs are looking, ESOP expenses are looking. Granted, these are material adjustments that we're making to the EBITDA and are not faithfully representative of the EBITDA itself. There's a reasonable argument to why it's important. And this is how we should be looking at it. So moving on to the actual numbers at hand. As you can see, when compared to the contribution, you can see these numbers are much smaller. But if you remember, the difference between the contribution for Eternal and Swiggy when it came to food delivery was about 1% only. So Swiggy was about 7.1% and Eternal was about 8%. But that discrepancy increases as we get to uh, adjusted EBITDA as these businesses scale. And there is a very similar thing to be said about quick commerce as well. And all the points about maturity of industry apply here as well. Now, the important point to note is, as of the latest quarter, Eternal just broke even, but Swiggy is also getting closer, but they've not gotten there. Just thought that was a important update. So these were all the key metrics, and these are all the metrics that you need to note down and then go back home and go to the shareholder letters for both these companies and read up on if you want to understand how these companies are doing, right? Additionally, because there is so much attention to these companies and because the companies are themselves very happy to give out a lot of data, I would like to highlight some of the metrics that might be misleading. And what are these metrics, right? So total orders is one very good example. Now, on the surface, total orders looks like a very, very important thing to track where you understand the volumes done by these companies. But the main thing to know about total orders is that it's not representative of the average order value, which is a very, very important metric that we need for profitability. Now, if average order value increases and number of orders increase, you know, gross order value is going to be more or less same with lower profitability because average order value decreased. But you might be looking at the total order values and be misled, which is why total orders are not generally the best metric to look at. And adjusted revenue is something these companies are very happy to report, which essentially is reported revenue plus the pass-through revenue, which is the customer delivery fee. Companies will, at least in the shareholder letters, this claims that this is a better representative of operations. But as far as most metrics are concerned, I don't think this is that much that important that you have to pay attention to it. So this might give you a wrong picture of how exactly the revenues are growing, right? Active riders and restaurants. So the thing is, these are important numbers to just know the scale of the business. But quarter on quarter or year on year growth of these numbers may not be indicative of how fast the business is growing. Because with the same amount of restaurants or the same amount of delivery partners, companies will be able to drive higher throughput. And hence, this might not exactly convey how well the companies are doing. Now, when it comes to dark store addition and dark store expansion, this is specifically for quick commerce, and these companies are also very happy to report that we've added so many dark stores and the network size is this much. But there are two important things to note here. One is that these numbers are not comparable between peers. Now, what do I mean by that? So, for an example, Swiggy has focused a lot on increasing the size of each of its dark stores. Now, each of its dark stores have grown to now the 4,000 square feet compared to the average of 2,500, 3,000 as we discussed earlier. And hence, they believe that the current store network they have of around 1,150 stores is enough to grow much more in the coming years. Whereas Blinkit has made no such declaration or decision and adds a lot more dark stores compared to Swiggy. Now, it may not be faithful completely to compare these dark store numbers because Blinkit is north of 2004. I mean, Blinkit is north of 2000 and Swiggy is just 1,000. So it doesn't mean that Blinkit is just capped at half of what, Swiggy is capped at half of what Blinkit is doing. It means that qualitatively you're supposed to look at these numbers differently. And another thing is, since Swiggy has taken a conscious decision to slow down dark stores addition and focus on profitability, it may not convey how operationally well they're doing just to look at these numbers. Of course, there's a different story when you look at the other important metrics we discussed before, but this number in isolation again can be misleading. And again, as I mentioned for the metrics earlier, these metrics will also be present in the shareholder letter. It is important for us to kind of take these numbers with a pinch of salt and focus more on the numbers that are more important. So that's what I broadly wanted to convey about the important metrics. Now moving on. Essentially, now that we've kind of understood how Eternal works on a numbers basis and how on pretty much every metric that we deemed important, we saw Eternal was head and shoulders above its competition, its biggest listed peer. We need to pay a little more attention to the qualitative side of things to understand, okay, what did they do in order to get where they are? In my view, there are two main things that are important to note. So one thing is how agile they've been when they've made mistakes. So this is one thing that they got right. So three important mistakes that they made in their growth phase between 2015 and 2025 is like they tried to do this international business from the beginning itself, like, way back in the 2010s. But when it realized it was not working, even though it had made a lot of acquisitions to expand in different markets, it quickly pulled out, right? In order to not drain any money around COVID time, in order to consolidate focus on the Indian market, which is a great decision. And then when it comes to like food delivery itself, though expanding food delivery as a business is much easier than quick commerce, they had the fortitude to understand, okay, in 2023, even though food was generating cash already, they exited 200 cities just because they didn't see a path to profitability, and they were not shy about admitting this as well. So they were very clear about their decision making to the investors. And though exiting 200 cities might sound like a very big thing, it was the right decision to make at the time, and the management made it boldly. And then the next thing is one of the main markets that they've been trying to enter lately has been quick food deliveries. And just like the other food delivery players believe, management also strongly believes that when people are served food quickly, they tend to order more food, right? And like they tried to do this in different ways with Zomato Quick and Instant across the years. But as soon as they realized that they didn't have a winning, profitable business model, they quickly pulled out. And these three are illustrations of how clear the management has been about profitability over the years. So this is one thing that they got right. The other thing that they got right is not this vague and qualitative, and it's much more the success of the Blinkit acquisition. So as we all know, they acquired Blinkit in 2022 and the markets were not too happy about it. They spent about 4,500 crores on this acquisition by diluting equity, which further hurt the shareholder value, which is already very thin in a business that just turned or had not even turned adjusted EBITDA positive at that point. Now, like all that said and done and all the negative reactions that, caused the stock price to plummet and stay sideways for a while, once they showed signs of profitability and once they showed competence in scaling this business, they never looked back, and so did the investors. Now, as we all know, quick commerce is bigger than ever and is officially a bigger vertical for Eternal than its own food delivery business, and now commands a very, very high, like $13 billion valuation as market leader. So this is something that really helped propel Eternal's market position. Then to just understand what's next in store for them. So as we discussed when we were discussing key events, they just purchased uh, Paytm's insider from them in 2024 for 2050 crores. And the way we should be understanding this is it's a ticket for the business into a 20,000 crore market that is set to expand at 15% every year. And, just to get a qualitative sense of how well this is doing, as we all know, there's a very strong live event and concert adoption among Gen Z people specifically. And, surveys show that over 70% of Gen Zs have attended at least one concert in the last year, which is very strong indication of adoption and growth of a market. And I'm sure we all must have read media reports or even attended one or two of these famous like concerts like Dua Lipa's, Coldplay's, Ed Sheeran, all these international visitors to India performing and seeing good traction, as well as homegrown talent also seeing a very good demand for tickets. So this is something that's very exciting and which is expected to propel the growth for the company. But admittedly, this district that Eternal has is in its nascent stages, and even the management has admitted that it's nowhere near what they've achieved with quick commerce or food delivery, and they're still looking for a product market fit. So this is what this is what we have to look forward to next. Before we conclude and share our final thoughts, I just like to highlight some of the news articles that have been going around and have been spreading, and some context to understand how these different news articles affect the company. So one major thing is the new labor code, which has a code on social security. One of the main things among those is for all contract workers and companies employing contract workers and all these gig workers, which have been getting a lot of attention lately because they're increasingly been formalized. All companies who employ gig workers are meant to keep 1 or 2% of their top line for a welfare fund. Now, this is a part of the draft of the Code on Social Security that had been released in November. And, from the early signs of it, there'll be no material change to how these companies operate. But full clarity on these new labor code as well as the Code on Social Security will be clear from April, from when, all the recommendations will be absorbed and the final code will be live. So, we are still awaiting clarity on that end. Now, moving forward to the next big thing, the worker protests. I'm sure some of you would have seen some tweets about workers protesting, and I'll just give you some numbers and some context to go with it. So, around 2 lakh gig workers, organized by various organizations, welfare organizations for these gig workers, they went on strike on December 25th of 2025 as well as December 31st of 2025, which are Christmas and New Year's Eve, which see very high traction in food delivery and quick commerce services, in order to highlight their struggles. So, I just like to highlight a couple of things about the strike that I feel are important. So, the main demands from delivery workers were surrounding pay and how they felt there was no transparency and how they felt it was a little unfair. And they wanted the government to intervene and do something about it, as well as how all these welfare schemes that these companies run are good in theory, but have not benefited them as much as they should in practice. So these are the key complaints that the gig workers had. Now, numbers wise, with respect to be it the Q3 results or what the managements have to say online or in calls, wherever, there's been no meaningful dips in impact, and all these companies have been very happy to share at order volumes and what kind of orders they got on all these high demand days. And so far, there's no impact from them. And there's been sporadic protests earlier about similar concerns of the gig workers in the past, and they've also not materially affected the business. Now, one important thing to note is Dipender Goyal and any other founders, they came out and posted tweets about their thoughts on the workers' demands and what the workers have been saying. And to just broadly sum it up for you guys, Like Deepinder Goyal says, even after all the fuel costs, delivery workers earn around 21,000 per month, for a certain amount of hours put into the business and all that stuff. And he believes that this is much higher than minimum wage, and there should be no complaints on the payment side of things. Now, he makes some very generous assumptions about how long delivery partners work, 10 hours a day and 26 days a month, which is a lot, right? And he also, in other places says that this is not meant to be a full-time job. So there's a little bit of a contradiction, but, and essentially that highlights that we should be taking these tweets with that context, right? We should not just be looking at the 21,000 number and taking that alone as information. The other thing that he highlighted is that there's no timer on the end of the delivery partner that forces them and doesn't pay them if they don't deliver in 10 minutes, and there was no reason to drive rash. The other context to this argument would be that though there is no 10-minute timer that the delivery drivers have to keep up with in order to get paid, incentive structures are really geared towards, pushing the 10-minute delivery for a lot of instances. Right? Again, additional context to what these guys are saying. Right? So moving on to the next item, which is, as you could have seen, there's a lot of instances in media and, in general, how they advertise these services that the 10-minute tag has been revoked. So media reports say that the government approached all these organizations and asked them to take out all these promotional material and, kind of do something about all these worker protests, and they've done it, and it's, victory has been achieved. But operationally, as far as the investor community is concerned, or the business is concerned, there are no indications that there'll be any difference in how they're operating. Maybe they'll be a little more gentle with the 10-minute delivery promises or the timing for the delivery promises, but overall, the belief and faith that it is the proximity of the dark store that enables 10-minute services and not the speed that the delivery rider is expected to go at remains, and hence the rest of the assumptions and rest of the operations of the industry that have been there so far remain still regarding profitability, regarding adoption, and all that stuff. So broadly, even though there's been a lot of negative news headlines with respect to how some parts of the ecosystem for food delivery as well as quick commerce have been working, there seem to be no imminent threats to how they are operating or to their profitability so far. Moving on to the next big news headline is, at least from the perspective of Eternal this time and not exactly the industry, is the news that Dipender Goyal has chosen to step down. Now, though this might seem like a huge change, right, as his own tweet summarizes here, two key things to note. One is that the new CEO role for the Eternal Group will be Albinder Dinsa, who's been with the quick commerce arm, which is Blinkit, since its founding. He founded Blinkit. So it's not like someone new from the system is going to come in and then take over. It's not like someone new from outside the system is going to come and take over. Someone who's very much used to how things work at the top in this group is only taking over. So on that level, on a strategic level, there's going to be no major changes. And the other thing is, it's not like he'll be completely stepping away from the organization. It'll just that he will operationally be involved, but he'll do less of the consumer facing or the talking, so to say, that Eternal does, and Alminder will be taking care of all that stuff. So, this is broadly three things that have been very interesting with respect to the company on the news headlines and our general context behind how to interpret these things and whether they'll materially change anything or not. And this is largely reflected in how we should be thinking about the next few years for the company.